Established credit and access to capital, brought to you by Experian and BBVA. My name's Gary Stockton. We'll introduce our two presenters in just a moment. But first, I want to take care of just a few housekeeping items before we get underway. You can submit questions during the program today via GoToWebinar, the applet you should see there on either side of your screen. There you can adjust audio settings and switch from dial-up to PC audio if you're having trouble hearing. If you don't catch all of today's broadcast, just rest assured that we will have a recording available and you'll receive a message about that in the next 24 hours. We've left a copy of the presentation for today in the handout section. You should see that also in the GoToWebinar applet. So if you need to download those for future reference, we'll also include a link in the follow-up email. Paul Ponsica is the National Sales Director for BBVA USA. He and his team are responsible for development and execution of BBVA's retail small business strategy for BBVA's 650 branch network. He's been in the financial service industry for over 25 years, with the majority of that time being focused on helping business customers. And Brody Oldham is the Senior Director here at Experian, working in business information services. He has 18 plus years of experience in analytics and database development. Prior to joining Experian, he worked at Citi Cards and Citi Mortgage as the Consumer Credit Risk Analyst Consultant. And now I'd like to turn things over to Brody to begin today's session. Brody.
Well, thanks, Gary. You know, again, I'm excited to be here. And quite pleased to be a part of this group and being able to, or having an opportunity to speak with you this morning. You know, when I think about small businesses, I'm a small business owner myself. You really have to have that entrepreneurial spark. And I know all of you have that, to really take something from a small seed and grow it into a business that is very productive and active. And when I look at the way that small businesses are and yours, the way that your small business performs, the activity it has, and this credit ecosystem really impacts the U.S. economy. And the way that we view small businesses really as an important factor in our regrowth, redevelopment, even recovery from, you know, even the most recent recessionary period that we've had in April and May of this year due to the COVID-19 virus and the spread there and some of the lockdowns that we've had. Small businesses have really helped to regrow and recapture some of those folks that have been put out of work and are able to bring them back in. You can see here some of the highlights that we've captured looking at the economy and your impact as a small business. So 2/3 of the new employment is coming from small business. That's from you. When we look at innovation, which is a big part of small business development, we know that this is one of those innovation spring points in time. So when we look at this recovery period, we look at the check mark in the economy where we had some depression in small business health and performance. We know that a lot of businesses have closed. A lot of businesses are reopening. So we have a record number of starts, business applications and starts coming in for the end of this year, which means a lot of new businesses into the market. And that creates a lot of innovation and a lot of just that spark that the U.S. economy needs as we go into the next couple of years of recovery. When we look at what your small business is, a lot of times it's global. It's not just in those urban areas anymore where business development has been happening. It moves into urban areas, rural areas, also onto digital platforms, which is very important at this point. So as we look at small business growth, you really are impacting the way that we do business as we go forward. You're inclusive of every type of person that's out there bringing in and starting new businesses. Every type of new business is really generated by you. So thank you for being a part of today's session. And as we go forward, what we'll look at are ways that we can help you be successful as you go forward. looking at ways to keep your credit profile vibrant and healthy. And today, Paul and I are going to give you a few tips, some guidance on how to improve your credit health, and give you really that access that we've talked about to affordable funding. So one of the things I like to start with when we talk about affordable funding is going to be really building business credit. And I think it's important. It brings to us the opportunity to see what business credit does is creates like a report card, some metrics that a lender or an investor can look at to really evaluate how you're honoring your obligations and repaying debts, repaying money that's been lent to you as part of a growth plan for your business. And you should really separate the two. One of the things that you'll hear Paul and I key on today is the separation between your personal credit and your commercial credit. And let me give you an example of that. One of the things that, just to talk about this scenario, when you're using your personal credit for business need or your business or your personal credit for your personal need, that separation is really important. And when I think about it, helping out a family member, I might put some of their debt onto my credit. It's going to come onto a credit card, or I'll open up a loan and it'll create some additional debt on my personal credit. Well, if I'm using that same personal credit for my business and I really need another piece of equipment to go forward to expand my business, what happens when I debt load onto my personal credit? It's going to cause my score to go a little bit lower. And we're going to talk about how that happens in the next few minutes. But it's going to make the cost of that new piece of equipment for my business just a little bit more expensive because my personal credit score is lower. And we don't want that to be a problem. I mean, we always say do unto others and help others in the way, and we don't want your credit to be a deterrent to really helping others as we go forward. As a small business owner, that's really what you do. When we talk about separation in another way, let's say that you are using your personal credit and you buy that piece of equipment on your personal credit. Again, you're debt loading your personal credit. In my case, my wife surprised me with the third kid coming, and I said, uh-oh. And some of you may have had this situation before, a third or fourth kid, and you have to get a little bit bigger of a car. Not all the car seats will fit in one car. Well, if you've loaded that business expense onto your personal credit, and now your score has gotten a little bit lower because your utilization is up. When you go out to shop for that car, a lot of times some of the cars that you really want, the pricing and financing that you'll need with a lower credit score, they're going to be a little bit more expensive, and it may price you out of the car that you really want. So when we talk about today splitting that commercial and consumer credit apart, it's very important. When you look at it, you can say, here's my consumer credit. If I reduce and take my business dealings out of my personal credit, then my personal credit's going to go up. Conversely, when I look at my business credit, if I am bringing that credit over that really belongs to the business credit, what I'm doing is making myself visible as a business, and that creates an uplift in my score as well. So let's look at how some of that happens. So I want to look here at the difference between what a business owner and a regular U.S. credit citizen really looks like. So U.S. business owner, when you think about yourself as a small business owner, you're going to use credit more frequently. You're going to have more credit that you're using. You're revolving some of that credit. And the reason why you can do that is you have that cash flow coming in and you're paying those debts down. You're also going to be less delinquent than a normal U.S. credit citizen, a person just using their personal credit. And why is that? Well, when I think about it, when you tie your livelihood to making payments on time, you're certainly, as an analyst and a statistician, when I look at this, you're more likely to honor those obligations if it's really tied to your livelihood. So as a business owner, think about the good that you're doing here and think about this is a way to expand and continue to grow. Now, one of the things that I'd like to talk about next is really acting like a business. So the first thing that you need to do is be a little creative. And as a small business owner, that's the spark that you have to be a little creative. Create your name for your business. Make it separate. I recommend not making it your own personal name. That certainly helps. So if I say Brody Oldham is my name, and then on my business it's Brody Oldham, it really creates too much of a connection between the two. So I might put Brody Oldham on my personal credit, and my business name might be Spark. So it's something totally different, but it may allude to creating that separation between my business and my personal credit. You want to make sure that your business credit is being reported, so that good payment behavior is really impacting your score and allowing it to rise up. That's what you want to see. You also want to monitor your credit, and we're going to give you an opportunity for an offer at the end of the call to be able to monitor your credit, and this is certainly important. You're probably doing this with your personal credit right now, making sure there are no bad actors, nobody from the dark web has sold your credit information and are creating credit cards. I live in Texas, somebody bought a snowmobile on a credit card of mine, and I said, when am I ever going to use a snowmobile? And they just laughed, and they said, well, it's on there. So it's one of those things where you really want to monitor, especially with a business, because you may have several owners in the business that can apply for credit. You want to make sure that you're monitoring that and make sure that nothing that's being set up is unauthorized. And of course, you want to make sure that your payments are made on time. That really does help to improve your score as you go forward. And when you think about this, it really is going to help you not only to expand your business and grow, but do it where you're honoring the obligations that you have. Now, if you look at the left-hand side of this slide, one of the things that we talked about was moving that business credit from your personal to your commercial. What we say on this side is that, as you add commercial credit, so if I add a card and then I add an installment loan to my commercial credit, what happens is I'm able to be evaluated through my credit score a little bit more, so my score goes up a bit. Now, I want to say this carefully because, like in life, you need to do things with moderation. And when we talk about moderation, you can see how the top of these bars level out as you go to the right. That means as we're adding credit, the value of that add is lessened and lessened. And so at some point, you're adding additional debt to your credit, and it can bring your score down. So again, make sure that you're taking out the credit that you need, and you're making payments and honoring that obligation as you go forward. And that's certainly going to keep your score on the up and up. Well, the next thing that I want to talk to is how a credit score really works. And when we think about credit scores, it's something that I do every day is build these types of credit scores. So scores like your FICO score, your Vantage score, and your personal credit. On the commercial side, we build other types of commercial focus scores that look at your commercial credit and create a number that is a value for your propensity to repay, and really tells us what ability you have to repay a debt if a lender or investor comes to you and says, or you go to a lender and say, I need to borrow a little bit of money. They know how much you can afford and how much they should provide to you. So keeping that up to date is certainly important. Well, let's look at a few of these on the right. And when I look at these, I really want you to draw some insights from what's here on the list and what really adds weight. But what I want you to be careful of is to say that really one to you as a small business is more important than another. So think about your credit. So I had a friend of mine one time ask me, okay, I have two large debts and in my business, and what I want to do is pay one of them down. And so to do that, I have to stop paying on the second debt to really pay this one down. Is that going to do me good to get all of this debt off of my credit? And my answer as a developer and as an advocate to small business is, it's good to honor your obligations on both those debts. So you may not pay them down as quickly on one side versus the other, but you're paying them as you should, and that will certainly help your score as you go forward. And when we talk about delinquency, so let's say that you stopped paying on one, a 30 or a 60-day delinquency on an account can bring a credit score down. On some credit scores that are 0 to 100, it might bring you down 5 to 10 points. On a regular score that, you may have had a 750 before, if you think about your FICO or your Vantage score, it can bring you down as much as 40 points, just having one 30-day to 60-day delinquency. So make sure that you're paying at least the minimum on time as you go forward, and that's going to keep that credit score going up. So continue to watch that as you go forward. None of these are more important really than another, but just so you're aware of what goes into a credit score when an investor looks at the health of your business and evaluates you as a partner going forward. So one of the next things that I'd like to bring out, the sun is bright. I'll tell you, it's great here in Texas, but you get a little hot sometimes. So, I am in the sun. So what I would say, let's talk a little bit about PPP. So PPP is the Paycheck Protection Program. When we come into economic times like this with COVID-19 and the spread, what you'll see is that the government, U.S. government, often the Small Business Administration will offer these programs. They're really kind of exciting programs to have in the market because they're loans that you can get at a very low price or even free at some times. And for a small business like you, what you'll see is that a large percentage of these PPP loans that were delivered early in the summer this year were picked up by very small businesses, large percentage of them. What we found in some of the research that we did at Experian is that those small businesses that picked up the PPP loans actually performed better. They had lower delinquency rates. They were healthier as we went through the lockdowns and are coming out of those lockdowns now. They're doing very well. So those types of government programs you certainly should look at as an opportunity to get some additional funding at low or even no cost at some point. So don't miss out on those. We should see another round of those coming out toward the end of the year. So be prepared for that. I think that opportunity doesn't come around very often. So it's a good chance to take advantage of some of these programs and really to help your business stay in a good position. Well, what I'd like to do now is turn this over to Paul to talk about some of the 5 C's of credit and how you can really set your business apart. Paul?
Yeah, thank you, Brody. Great information. And we just want to make sure you can hear me, right?
We can.
Okay. And I'm in San Antonio, Texas. We don't have any sun today, so hopefully I'll be spared. So anyway, I want to demystify a little bit around business credit and try to boil down, my years of experience into a few minutes where you can leave with some information and a little bit better understanding of, what a bank looks at when we look at a credit application. So there's a lot of pieces that we review, and kind of the basics of it are what we call the 5 C's, which essentially an underwriter is going to look at to determine, does this customer or borrower have the willingness and ability to pay us back for whatever it is that we're looking at. So that could be a credit card, business loan, line of credit, et cetera. So I want to start with the first, which is character. And I put this one first. They're not in alphabetical order. The character is probably the one that ties most closely back to what Brody was speaking about when we look at your personal credit bureau and your business credit report. This is really the historical look back of how you've handled your obligations. So how many accounts have you had? How long have you had these accounts? Are you paying on time? If you have credit cards, are they revolving? And banks like stability. So even something simply as, are you in a home? Have you been at the current address for a long time, or have you had multiple addresses? It's just a better predictor of, how we can anticipate, repayment. So we look at the credit bureau reports, business or personal, is kind of the past to hopefully help predict future repayment. And that is the number one thing an underwriter looks at. And I've sat with underwriters as they review credit requests, and the first thing they look at is the credit bureaus before they get into any numbers, or if it's a business plan or projections or anything to the like. The next C is capacity. And this is essentially that can you repay the loan? And in its simplest form for smaller requests, we look at debt to income. It's like how much money do you as an individual make and how much debt do you have? And that is something that we're looking at because we'll put in the new debt, whether it's a credit card or a line of credit, and we have debt to income ratio that we want to adhere to. And the better your credit report or your credit scores are, the higher we can go as far as the debt to income allowance. As the risk increases, pricing increases too. So Brody talked about maintaining your credit, managing it, in kind of monitoring it. You want to be able to get the best pricing for whether it's a business loan or line of credit, credit card, et cetera. So you want to make sure that you're managing that. Next is capital. This is essentially your net worth. This is all of the stuff that you own as an individual compared to how much money you owe on that on those assets. So you may own a house, a car, other things, and we look at how much debt you have out there, either on those assets or beyond, and that gives us really the kind of your capital position. And that's really important because the more you have as far as assets less liabilities, it gives you options if you need to find ways to repay a loan, something that can help you get over a hump, which we know happens in these different economic cycles. So the higher your net worth, it gives us as a bank a little bit more comfort that you can weather some challenges as things move forward. So on the next page we have collateral. Collateral is for different loans. We have collateral and some are really unsecured. So I want to talk a little bit about what I call kind of the collateral stacking order. So if we have collateral on a loan, that's something that ties to the loan that the bank has right to take ownership if the loan isn't repaid. And again, this is not what we want to do as a bank, but again, it's part of our mitigating risk. So, and it also impacts pricing. So the least risk for us is a cash or CD secured loan. And a lot of times those are used if you have damaged credit or if you are trying to establish credit and you've got money in your personal name, then a lot of times we utilize that to get a first credit card or a line of credit. And sometimes you could be well established as far as your business credit and personal credit. You just utilize your personal funds to get really low cost funding on a loan or a line. And we see a lot of that as well. Business buildings, whether you purchase a office condo or your warehouse or wherever it is that your place of business is a great form of collateral, and we finance a lot of buildings. And we like that type of lending because that asset not only gives you value as an owner, but it also is, from a collateral perspective, great because you have insurance on it. We're on the title as well, and that's an appreciating asset. So when we do a loan on that, we know that, where we assume that hopefully the value either stays the same or goes up. Next would be equipment or vehicles, anything with a VIN or a serial number. We use that on term loans. And then after that, we really have kind of our unsecured lending. This is the highest risk, but it's also probably the one we do the most because a lot of our lines of credit are small. We don't monitor them. But the risk also means from the pricing perspective, they have to be priced accordingly. So they're a little bit higher as far as pricing goes. The next I want to talk about is conditions. This is all the external factors that can impact a business. Your local economy, how your industry is doing and performing, different tax laws that may or may not impact businesses. These external factors, a lot of times we have to look at to determine, a borrower's ability to be able to repay based on what's going on. If we look at what's going on now, think about COVID. You could be a restaurant owner in Houston or in Santa Monica, California, or in New York or in Florida. You have 4 different markets, 4 different laws going on that could impact your business. You may be open, you may be forced to close, you could be at 50% occupancy. Well, right now we're having to look at those local conditions and ask the borrowers about their current situation so that we can make the best decisions, as a bank. So that's the 5 C's. I'm going to throw in a bonus. The last C is not a C, it's a R. The last is relationship. And this is important because the relationship does matter. And the length and depth of a relationship is also something we as a bank look at. So the longer you've been with us, the depth of a relationship, whether it's business accounts or personal accounts, and other products and services, it does help us see that stability that we're looking for that helps us make the best decisions. So if we go to the next page, this is really important. Is some of you may be brand new business owners, you could have been in business for a while, but picking the right product is critically important. And so let me go through all of these briefly. I know you've heard of all of these, and you don't have to know all this. If you go into a BBVA branch, or if you have a business banking relationship manager, they are there to guide you to the right product. But we want to inform you and make sure you kind of understand, what you should be looking for. So a business credit card. There is not a single business on this call today that I would say does not need a business credit card in a business name. This is what Brody mentioned earlier. It's really a payment vehicle, and you can use bank financing, for 25 or 28 days, whatever the grace period is. You get to use our money essentially for free, and you repay it at the end of that billing period. And there's essentially zero interest. The other great thing is you get fraud protection, you get points, you get to separate out, and you've got, a business credit card that gives you credibility when you're, purchasing, gives you electronic tracking for reporting purposes and billing. So there's, if you do not have a business credit card, that is a great, something you can start with. Business credit cards shouldn't be used to purchase assets, long-term assets. I've seen folks that buy, I've seen people buy vehicles on credit card, and you may get the points, but it becomes very difficult. Credit cards are higher rate. When you have better collateral, you want to get a term loan, which is something else I'll talk about. So anyway, credit cards for every business would be mostly appropriate, and I highly encourage you to consider that, for the right situation. Line of credit. These are used, I want you to think about an EKG machine. It's a heartbeat. It goes up, it goes down, it goes up, it goes down. That is what a line of credit, how that should perform. And it allows you to get, whether you get trade discounts or you need to purchase, amount of inventory, or if you send out invoices. It's really to cover short-term interruptions in cash flow where you produce a product or a service and the payment's going to come a little bit further down the road, or you're manufacturing something. So that's how the credit product should perform. Most lines of credit are interest only. So the thing I always tell business customers you have to guard against is that the temptation to pay interest only. So I have seen lines of credit utilized to purchase a vehicle, and the interest only payment is utilized for 2, 3, 4 years. Well, guess what? When the business now needs to get a new vehicle, because that one is its useful life, there's still the full amount of that purchase is still on the line of credit. So that's not how you want to utilize that. So it should go every, just say 90 days up and down. And it's a great tool for a small business or a growing business to utilize. On our next slide, we have term loan. This is the most common. So this is essentially, if you go to a dealership, you purchase a car on the personal side, that's a great example of a term loan. And this helps you keep your cash on hand. You can stretch out the financing. I always recommend that try to get the term to match the useful life or how long you expect that asset to be utilized for. So for example, if you're going to buy a truck for your business and you expect to keep it for 3 or 4 years, you would want to match the term to that, or make sure you have enough value to where you can pay off that loan. You don't want to have to roll to a new piece of equipment or vehicle and you still owe a lot on the one that you purchased in the first place. So that goes back to what I mentioned on the line of credit. You want to make sure you use the right tool out of your toolbox. Next is commercial real estate loan. And as a new business, probably not as likely to utilize a loan, but as you get longer, if you've got a business that is not home-based, and if you have the luxury of working at home like I do today or like Brody does, then that's great. But a lot of businesses need a storefront, whether it's retail or whether it is your warehouse or your physician. If you have the opportunity to purchase your own building, that's a great opportunity for you. And you can finance those up to 20 years, or as I'll talk about a little bit later, you can even utilize SBA. So things I want to mention, just stress on the last couple of slides are just, there's a few different tools in your toolbox. You just want to make sure you utilize the right one for the right situation. So as we move to the next page, I want to talk a little bit about SBA. And a lot of business owners, they're misinformed or they don't understand what SBA is. So let me kind of explain, how banks work with SBA. So an SBA Small Business Administration does not lend money generally, although they do have the ability to do so. And in kind of crisis, they do have that. And I think we saw that with the COVID crisis. But in general, banks the SBA gives banks the ability to take more risk than we normally would in conventional financing. So we receive a guarantee from the SBA on loans that kind of fit the box that they help us manage to, and they'll guarantee 50% up to 75% of loans that we're able to do. So it's not a government loan as much as it is government insurance that banks are able to obtain to be able to lend more money. And one of the things I want to stress about, a bank or underwriters is, we want to lend. That is one of the few ways a bank can make money. So the SBA gives us that opportunity to be able to lend a little bit more. And it's really good for clients. In a lot of cases, we have clients that could conventionally qualify, but they prefer SBA because you get a longer maturity. You can stretch out a building purchase to maybe 25 years. You only have to put in 10% in versus 20 or 25%. And you really get a lot of more creativity on SBA because we can roll a lot of fees into it and some soft costs. And the great thing about working with BBVA is we're a preferred lender. So what that means is, it speeds up all the approval process. We're able to approve in-house, and all that SBA does for us is just really verify the eligibility. And to be eligible, it's a pretty big umbrella. You've got to be a small business, which is generally less than 500 employees, which is, as Brody mentioned, pretty much 99+% of businesses. U.S. citizen, you couldn't have defaulted on another SBA loan. No felonies or recent bankruptcy. So it's pretty broad, and we utilize it often. And we're proud to be one of the top 20 SBA lenders consistently. And we've got a great team that helps our clients when a business either needs to go SBA or just prefers to. So the next slide is really talking about conventional underwriting. And this is how we look at every loan first. We look at every loan first as, do we have the opportunity to go conventional? That means, we utilize our own underwriting guidelines to review a request, whether it's a credit card, line of credit, or term loan. So the main piece of this slide, I'll get into the nuances of profitability, leverage, liquidity, and debt service coverage on the next slide, is really you have to be in business at least 2 years. And one of the things I want to stress is, when we look at, when we review credit, the longer you're in business, and this kind of goes back to the credit bureaus, banks like stability. So if you've been in business, if you have the luxury of being in business 5 years, 10 years, 20 years, I've seen businesses that are generationally shifted hands, then an underwriter is able to say, wow, this business owner's been in business, or maybe you've been in the industry for 15 or 20 years and you've started your own business. But that knowledge and stability, gives underwriters a little bit more comfort that you've been able to weather different economic storms and challenges, et cetera. And you've been able to survive and you've learned from those experiences. So that's something critical as you start your business or you grow your business or you've been in an industry for a long time. All right, on our next slide, and these probably pertain more to larger loans than smaller loans. But as we look at larger credits, and when I'm saying larger, I'm saying 250,000 plus. They're more complex, and we have to look a little bit more in depth to see if they qualify conventionally. So first, we look at profitability. And this is the simplicity of, did your business make money? And I know that there's a lot of temptation out there to run a lot of personal expenses through the business, and most of that is totally legitimate and appropriate. But at the end of the day, if you've got a business that shows that it's losing money, it makes it uncomfortable for us as a bank to look at it and say, we'd like to lend that business money, because our primary source of repayment is going to be that business. And all we have to look at when we look at profitability is going to be, business tax returns. So I know the temptation is often, as I've talked to business owners, is, you want to minimize taxes, but in some cases it limits or prohibits the ability to borrow. So that's something you need to discuss with a CPA or tax accountant, or just really understand, how that can impact you. Liquidity is important. And on larger loans, we really look at liquidity to see how the business is going to be able to handle, the next, few months. We have a ratio, it's called a current ratio. We look at your cash, your accounts receivable, inventory, which are really called short-term assets, and we look at, your short-term, liabilities to see, as businesses currently, do they have enough short-term assets to be able to cover, their existing, debts. So that is a core ratio that we look at. So I want to make you aware of that. The next is leverage. This is essentially your business liabilities divided by the net worth. If, in its simplest term, every business starts with an investment from an owner. He or she puts money into the business, and then over time, as you essentially work through your finances, you can retain value in the business through retained earnings, or you can draw out everything in cash. At some point, you want to have assets either on the personal side or retained in the business to offset leverage. And I know the temptation to grow for a lot of businesses is very tempting, but you don't want to become over leveraged where you have so much debt outstanding, there's not enough assets, whether it's in the business or globally, on the personal side, to be able to have a manageable leverage ratio. So we look at 4-to-1 as an appropriate leverage to make sure it's not too much, and that's kind of a good, healthy indicator of what we're looking at. The next is debt service coverage. And again, we're looking at larger loans. This is the key ratio we look at. For smaller loans, especially under 100,000, we really look at debt to income on the personal side. But as loans get larger, we look at global debt service coverage. And in its simplest form, this is all of your personal and business income combined and compared with your personal and business debts. We also have to add in living expenses, because you may have a house note, car note, business loans, credit cards, but you also have to live. You've got to go to, if you're in Texas, HEB groceries, or Publix if you're in Florida, but you've got to have living expenses, so we factor that into. And we'd like you to have kind of standard underwriting at BBVA and elsewhere is 1.25 is the appropriate conventional debt service coverage. That means for all of your obligations, if you have $1 worth of obligations, including your personal expenses that we have to factor in, we want you to make $1.25. That extra quarter gives us and you some comfort in breathing room for the unexpected. So that's how conventional underwriting really looks. Now, SBA will allow it to go further, all debt service coverage, maybe down to 1.15. But as you get closer to 1-to-1, that means 1-to-1 means your expenses, your debt plus your living expenses is exactly how much you make. And that means you can't take on additional debt because you're barely able to repay. So all of that factors in. And the key thing I want you to understand is if your business and your personal income are too close to the outstanding debt, it makes it very hard for a bank, even with SBA guarantees, to be able to want to take that additional risk and lend. And again, banks want to lend. That is how we make money. So we definitely want to try to make sure we educate you on that. On our next slide, it talks about 3 different types of SBA loans. And there's 3 different programs that are pretty broad. We have a 7A, a 504, and SBA Express. The 7A loans are really we can use them for real estate. We do use them for construction loans for someone that needs to construct a warehouse or a building to exact specs. But a lot of times we use them for business acquisition. These loans can go up to $500,000. They're 75% guaranteed. Again, they usually require a 10% equity injection, and all the fees that would be associated can get rolled into the loan. So it is a tool we use, usually going to be for loans over $350,000, but it allows us to help clients that don't want to put in as much equity or don't have, more to put into a particular request. And it helps us, be able to lend a little bit more. The 504 loans are generally loans we do for a building purchase, or in some rare cases could be for a really large equipment purchase that has a long lifespan. I'm thinking really large industrial equipment that may have a 15 or 20-year lifespan, and we may use a 504 for that. And the way those operate is it helps us spread the risk so we can lend more. So we would take 50% of that request. If you're borrowing $1 million, BBVA would take $500,000. We work with a certified development company, which are local in your community, to take that 40%, and then you as the business owner would put in the additional 10%. And that's a really good structure to allow us to do more and keep pricing down and allow you to kind of see what your goals are and help you meet them. The other loans we do a lot of here at BBVA or Sba Express. Those are under $350,000. And we get a 50% guarantee on these. And a lot of our lines of credit or unsecured term loans, we utilize this Sba Express because there's not collateral for them. And it only requires a year in business, although back to what I mentioned earlier, the longer year in business gives us, a little bit more comfort to be able to lend. So you just kind of keep that in mind. All right, on our next page, it's really the documents that we need. And the reason we put this in here is so you kind of know up front, what is it that you're going to really require? What is a bank going to require for you to get a loan? And this is fairly broad. So every loan, you're going to have a business credit application. And one of the things that's going to be on here is going to be your business information. And as Brody talked about earlier, it's, that you're going to have you have a separate business name, an entity. And then on that application, there's also a place for a personal guarantee. And we, like most banks, we want you as the business owner to also personally guarantee that, hey, if the business can't repay the loan, that, me as the business owner or you, are willing to repay it. That's very common. And the way I've kind of explained it to business customers in the past is, the bank is very limited on what we'll make on a loan. We may make, 100 or 200 basis points or whatever it is over our cost of funds. The business owner can make, unlimited gains on that loan. And, we don't want to take more risk than the individual that's going to benefit from that. So we require a personal guarantee on our loans. And that's why we do look at your business credit and your personal credit. And we like that longer track record and that stability when we make decisions. As loans get larger, we have to look a little deeper. So like requests under $100,000, we generally don't need business tax returns. But as they get to be above $100,000 or above $250,000, we'll ask for 2 years or 3 years business and personal tax returns. Current year business financial statements, that's going to be your current balance sheet and income statement. Your current personal financial statement, that gets back to what I mentioned earlier around capitals. Like, what is your net worth? How much personal assets do you have, and how much personal debt do you have? That all goes on the personal financial statement. If you're buying something, whether it's a vehicle for your business or work car or a piece of real estate for your business, a warehouse, we want to see the sales contract or the purchase order or the sales contract if it's a building. And then if you are constructing a building, which can be the most rewarding and stressful thing you ever do, but the reward at the end is a very customized, perfect fit building for you and your employees, we would want to see the construction bid or estimate. And those usually will go through SBA, just because there's a lot of inherent risk on construction. But today we wanted to give you an overview of a lot of kind of how credit works and what we look at. But one of the things I want you to really understand is you're not in it alone. You know, we've got resources at BBVA across our 640 plus retail branch network and our business banking relationship managers. They're really there to help you. So today you got an overview of business credit and personal credit and how that works and how banks look at credit requests. But the easy solution is to go to your local branch, talk to your branch manager who are trained in business lending and business credit cards, or if you're a larger business, which generally is $1 million plus, we have business banking relationship managers that work with more complex businesses that have more complex needs. So this is an overview. You don't have to go it alone, and I would advise you to connect with your local branch manager or relationship manager to really get more information in depth into this. So on this almost last slide, you know, I've been in business banking for about 14 years, and y'all probably don't know this. I know you don't, but I'm on vacation now. This is how I'm spending my vacation. There's nothing more rewarding than really helping business owners. And I've worked with small business owners and I've worked with commercial size clients. When you get to a certain size, you don't really need help. You have a CFO and somebody that takes care of your bookkeeping, your accounting. You have an army of attorneys. When you're a small business, you wear most of the hats. You're the chief marketing officer. You're the CFO. You're the CEO. You're pretty much one and all. So I prefer to work with businesses like probably most of you on this call. And there's nothing more rewarding to me than we visit with a business owner that has plans and goals, and he or she wants to grow their business. They want to transition it to a family member, and we help you, achieve those goals, hopefully right away. But if not, it may take weeks or a few months of working together to get you to the right place. So I want you to know that, BBVA is here and we've got plenty of resources. And I don't mean that in the term of product and services as much as I do the people that are out in the field that are out there willing and able to help. So in summary, and Brody hit on this a lot, you have to act like a business. I know the temptation to roll everything on a personal credit card for business expenses may be tempting for points, but you really want to separate it out so that you can help, establish your business credit. And also, make sure your personal credit doesn't pick up additional debts for your business. It can help you on both sides. Be visible. You're a business owner and a business, but you have to make sure you're marketing yourself and behaving as such. Monitor your credit. 10 or 15 years ago, I probably wouldn't have worried about this as much. As Brody's mentioned, he's had a snowmobile purchased. I've had credit card fraud. It is not uncommon anymore. And you can't leave it to chance to where you go to get a loan or a credit card and then you find out something is happening that you weren't aware of for the last 3 or 4 or 5 months. And as a bank, we can't remove things from your credit bureau, and we have to act on what's on there until those things are alleviated. So it is a very important. And plan ahead. The main things I went through today were very high level of business credit and what we look at. But know what your goals are and how you can help plan ahead of what you would need and what your particular situation would call for. And don't be afraid to use credit. Credit can be your friend. You don't want to be over leveraged, but credit can help you maintain and grow your business. So those are the things I want to leave you with. And it definitely has been a pleasure spending a little part of my vacation with you. And with that, I'm going to turn it back over to Gary to wrap us up and explain how you have an opportunity to get to manage and monitor your business credit. Gary?
Oh, thank you. Great job. Great job, Brody. Thank you so much, gentlemen, for sharing it. Just gold, just really excellent information today. And folks, if you need to get in touch with BBVA or Experian, I'm going to put our connection information up on screen here. Also on Business Credit Advantage, that's about monitoring your business credit in an ongoing basis. It's a service that Experian offers too. But if you give us feedback on this session that you've heard today, when you exit, there's a question. The first question that you exit is yes to be entered into a drawing to receive a free year of Business Credit Advantage, and that's $189 value. So if you want to monitor your business credit, and I highly urge you to do that, please give us that feedback, but answer yes to the question that you want to be entered into the drawing. It's going to be to the first 100 people who answer yes on that question. And then you'll receive an email. The other thing is you need to make sure that you add Small Business Leads US at bbva.com. If you don't have that email address in your contacts, make sure that that's in there so that that message doesn't go into your spam folder. So Small Business Leads US, is that correct, Paul? Am I getting that right?
Yes, Gary, it's smallbusinessleads.us at bbva.com.
.us at bbva.com. And with that, I'm afraid we didn't leave any time for questions today. If you did leave us questions, we will certainly be following up with you with a response to those questions. And I want to thank everyone for attending today. And thank you, Paul, Brody, and everybody from BBVA that helped put this session together.